Okay, hello everyone. In our today's session, we will continue our topic of APV, adjusted present value, which we started in our last class. So let's get a quick recap of the last class. In the last class, what we did was we started the topic of APV. I told you APV is adjusted present value, or it is called NPV with some adjustments. There are some errors in NPV as per the concept of APV, which do not give a true picture. But so that's why whatever is ignored by NPV, you need to involve that or incorporate them in your NPV calculations. Okay. Then next issue, how to deal with APV. You need base case NPV, then 5 adjustments: tax savings from interest payment, subsidized loan benefit after tax, issue cost, tax savings from issue cost, etc. Then when to use APV and assumptions of APV. So in assumptions of APV, when calculating base case NPV, discount factor is KE. When calculating NPV of remaining items, discount factor is KD. Only ungearing, no regearing is done. We use beta asset, no beta equity. When to use APV, if the question asks to find NPV, you find NPV. If the question asks to find APV, you find APV. But if the question asks to evaluate acceptability, you need to select between NPV and APV. You need to always calculate NPV whenever you are asked to evaluate acceptability, but unless three conditions are present, any one of them. There are issue costs, subsidized loan benefit, major portion debt, then use APV. We discussed an example. Now we will be starting a past paper question called Fubuki. Okay, so I'm starting reading this question and you need to pay attention. Okay, so the question is, Fubuki Company, an unlisted company based in Megara, has been manufacturing electrical parts used in mobility vehicles for people with disabilities and elderly for many years. So Fubuki is an unlisted company. It's based in Megara. It has been manufacturing electrical parts and used in mobility vehicles for people with disabilities and elderly for many years. These parts are exported to various manufacturers worldwide, but at present there are no local manufacturers of mobility vehicles in Megara. Retailers in Megara normally import mobility vehicles and sell them at an average price of 4,000 each. Fubuki wants to manufacture mobility vehicles locally and believes it can sell vehicles of equivalent quality locally at a discount of 37.5% to the current average retail price. Okay, so in the first paragraph, Fubuki is an unlisted company based in Megara. It has been manufacturing electrical parts. So pay attention. Manufactures electrical parts, right? So Fubuki is a company which manufactures electrical parts used in mobility vehicles for people with disabilities and elderly. These parts are exported to various manufacturers worldwide, but at present there are no local manufacturers. So these parts are exported to various manufacturers worldwide, but at present there are no local manufacturers of mobility vehicles. So Fubuki makes electrical parts. Fubuki makes electrical parts for mobility vehicles and exports those parts. At present, there are no local manufacturers of mobility vehicles. Retailers normally import mobility vehicles and sell them at an average price of 4,000 each. Fubuki wants to manufacture mobility vehicles locally. Fubuki makes electrical parts and wants to manufacture mobility vehicles locally. So see, it manufactures electrical parts, okay, but now wants to manufacture mobility vehicles. So the company is making electrical parts, but it is now wants to manufacture mobility vehicles. It is making parts, wants to manufacture mobility vehicles. This is a case of diversification. Manufactures electrical parts, but wants to manufacture mobility vehicles locally. Diversification. However, if we're still unclear whether it's diversification or not, I always told you in LAC that you need to read the question till the end. If any proxy data is given, that confirms it's diversification, okay? So Fubuki wants to manufacture mobility vehicles locally, believes it can sell vehicles of equivalent quality locally at a discount of 37.5% to the current average retail price, okay? Now, although this is a completely new venture for Fubuki, it's a new venture for Fubuki, it will be in addition to the company's core business. Fubuki's directors expect to develop the project over a period of 4 years and then sell for 16 million to a private equity firm. Megara's government has been positive about the venture and has offered Fubuki a subsidized loan of up to 80% of the investment funds required at a rate of 200 basis points below Fubuki's borrowing rate. Currently, Fubuki can borrow at 300 basis points above the 5-year government rate. So this is a completely new venture. It's in addition to company's core business. Fubuki's directors expect to develop the project for a period of 4 years, then sell for 16 million. Megara's government is giving some subsidy, so note subsidy, okay? A feasibility study commissioned by the directors at a cost of 250,000 has produced the following information. So feasibility study, research study commissioned by the directors at 250,000 cost, that's a past cost and cost has produced the following information. Initial cost of acquiring suitable premises will be 11 million. Plant and machine used in manufacture will cost 3 million. Acquiring premises and installing machinery is a quick process and manufacturing can commence almost immediately. Second, it is expected that the first year 1,300 units will be manufactured and sold. Unit sales will grow by 40% in each of the next 2 years before falling to an annual growth rate of 5% for the final year. After the first year, the selling price is expected to increase by 3% per year, okay? Third, in the first year, it is estimated that material, labor, variable overhead cost will be 1,200 per unit. After first year, the direct costs are expected to increase by annual inflation rate of 8%. Fourth, fixed overheads annually would be 2.5 million, of which 60% are centrally allocated, which are irrelevant. Fixed overhead cost will increase by 5% per year after the first year. Fifth, Fubuki will need to make working capital available of 15% of revenue at the beginning of each year. The working capital is expected to be released at the end of fourth year. Okay, you have studied all of this. That's not so difficult thing. Fubuki's tax rate is 25% per year on taxable profits. Taxes payable in the same year as profits are earned. Tax allowable depreciation is available on plant and machine on straight line. You always remember tax allowable depreciation is only available on plant and machinery straight line basis. It is anticipated that value attributable to plant and machinery after 4 years is 400,000 of the price of its project is sold. So project will be sold for 16 million, and it is anticipated that value attributable to plant and machinery after 4 years is 400,000 of the price at which product is sold. So of the price at which product is sold is 16 million, plant and machinery's value is 400,000. No tax allowable depreciation is available on premises. We all know that. Fubuki uses 8% as discounted for new project, but feel this rate may not be appropriate for this new type of investment. It intends to raise the full amount of funds through debt finance and take advantage of government's offer of subsidized loan. So it intends to raise full amount through debt and take advantage of government's offer of subsidized loan. Issue costs are 4% of the gross finance required. It can be assumed that debt capacity available is equivalent to amount of debt raised. Last para. Although no other companies produce mobility vehicles in Megara, Hesem Company, a company listed, produces electric powered vehicles using similar technology to that required for mobility vehicles. Hesem's cost of equity is 14%, pays tax at 28%. Hesem has 15 million shares in issue trading at 2.53 each and 40 million bonds trading at 94.88 per 100. The 5-year government debt yield is estimated at 4.5 and premium is 4%. So no companies produce mobility vehicles, but Hesem Company produces vehicles. So proxy is given that confirms this diversification. Okay. Evaluate on financial grounds whether Fubuki should proceed with the project. So you need to evaluate on financial grounds whether Fubuki should proceed with the project. Okay. Now do one thing. This question is also present. Wait a second, please. In that note links which I have sent you of Google Drive, and in investment appraisal, it's picture number 26 and 27. It's picture number 26 and 27. You can also refer the question from there. Fubuki Company, picture number 26 and 27 of that investment appraisal file. Okay. So I am giving you 5 minutes. 5 minutes. Just read the question and then I will start the solution. If you want to read from the screen, you can read from there. Else file number 26 and 27. Okay, let's start the solution. Now the question isn't open. It is asking evaluate on financial grounds whether for books should proceed with the project. So whenever the question asks you to evaluate whether we should proceed with the project, evaluate whether we should proceed with the project, we usually find NPV. Whenever the question asks us to evaluate whether we should proceed with the project, we calculate NPV. But after the discussion of topic APV, we have asked you that if the question asks to calculate NPV, we will calculate NPV. If it asks APV, you will calculate APV. But if the question asks evaluate whether you should accept the project or not, this means we need to calculate NPV or the improved form APV. What to do? I told you to always calculate NPV, but if conditions are present like issue cost, subsidized loan benefit, or major portion added, any one condition, then you should calculate APV. So look at this question. It isn't asking NPV, it isn't asking APV, it's asking whether we should accept the project, proceed with the project. So usually it's NPV, but if any condition is present, we will calculate APV. So there are issue costs present in the question, there is subsidized loan benefit, so we will calculate APV here. Okay, and when we need to calculate APV, we need to quickly write the format of APV. That is base case NPV. Okay, and then those adjustments. What are those adjustments? Present value of tax savings from interest payments, it's a benefit. Then present value of subsidized loan benefit after tax. Then issue cost expense will reduce NPV. Then present value of tax savings from issue cost, it's a benefit, and any net gain from closure of operations. Okay, so to deal with all of this stuff, the first thing we need to find is base case NPV, and that is what we are going to calculate in today's session. Other items we will be discussing in the next session. So my first target is to find the base case NPV. Now I have told you multiple times base case NPV is just like your normal NPV. Okay, your normal NPV. So what is the first step of NPV? The capital allowance schedule. And for this capital allowance schedule, we need 5 things. Investment, only plant and machinery, 3,000. Scrap value, only plant and machinery, 400. Life, 4 years. Tax rate, 25%. Same year. Capital allowance, straight line. Okay, let's start. So once you get the 5 things: investment, scrap value, life, tax rate, and capital allowance straight line, you need to make 3 columns for capital allowances: year, capital allowance in which we charge depreciation, and tax rate. So it's a 4-year life. Okay. Straight line method formula: cost 3,000 minus scrap value 400 over life 4 years. Okay. It becomes 650 each year. In the last year, we work differently. We first find net book value. Okay. Cost less accumulated depreciation of 3 months. 650, 650, 650. It's 1950. So net book value is 1050. All should be charged last year, but we received scrap of 400. So leftover figure is 650. Charge all this last year because the figures in straight line have to be same each year. And we have discussed multiple times depreciation reduces profits, so will reduce tax. 650 depreciation means profits get reduced by 650. Tax will reduce by 30% of 650. Tax rate is 25%, sorry. So 650 into 25% makes it 162.5 each year. And I've told you this is the only relevant column, the last one. Whatever amount is coming as savings, you should record it as inflows. Okay, copy this stuff, please.
सर अस्सलाम सर हो सकता है करवाना पड़े आपको क्योंकि यूएई वाले तो हर तकरीबन मतलब काफी सस्ती है सबसे ज्यादा यूएई है ना हमारे पैसेंजर वहां से आ रहे हैं अपना ऑरलैंडो से कराची आ रहे हैं ट्रांजिट करते हुए इत्तेहाद एयरवेज उनको भी कहा कि भैया आप कोविड टेस्ट करवाएं तो मेरे ख्याल से शायद करवाना पड़ेगा नहीं मतलब
Okay, now after this base case NPV stuff, the first step capital launches, the second step is exchange rates. Okay, so there are no exchange rate issue in the question. So we move towards the third step. Third step is NPV. So 4-year life means makes column 0, 1, 2, 3, 4. Let's start. Okay, so the first step of base case NPV or normal NPV is capital losses. That's done. Then the second step is basically the exchange rates. That's not the question. Third step NPV. Okay, let's start. Investment. So what is the investment in premises? I think it's 11,000 in premises, and plant and machinery 3,000. And after investment, we get revenue. So selling prices, they are willing to sell the product for 37.5% less than the original market value. Okay, so 35% less than the original market value. Let's calculate it. 37.5% less than original market value, 4,000 makes it 2,500. Okay, multiply by the units, and this will inflate by 3% per annum. So 2,500 is the selling price of first year. Okay, 2,500 is the selling price of the first year. You multiply it with units. Okay, that's 1,300. Okay, makes 3,250. It's increasing by 3% every year. So increase it by 3% every year and multiply it with 1,820 units of second year, 2,548 units of third year, and 2,675 units of fourth year, because the sales volume will be 1,300 units in year one. Okay. 40% in each of the next 2 years. Increase that 40% and then 5% for the final year. So units are going to be 1,300, then 1,820, then 2,548, and finally 5%, 2,675. Okay, so selling price 2,500 in first year, multiply by 1,300 units, 3,250, increase by 3%, multiply by units, 4,687, then 6,758, and then 7,308. Okay, then revenue, you should deduct cost. Okay, cost 1,200 in first year and increasing by 8%. So 1,200 in first year, multiply by 1,300 units, 1,560, increasing by 8%, multiply by units, 2,359, 3,566, 4,044. Okay, then fixed cost. It's 1,000 in first year. How come 1,000? We are seeing some other figure. So fixed cost 2,500 each year. 60% are centrally allocated. Centrally allocated are irrelevant. Only 40%, 1,000 will be relevant, and 5% each year after the first year. So 1,050, 1,103, 1,158. Okay, so you have written revenue, you have written variable cost, you have written fixed cost. So you all know revenue less variable cost less fixed cost will give you taxable profits. Okay, then test frequency may result in answers being slightly different. 1278. Okay, on this taxable profit, we have to pay tax 25% a year. Year 0, no profits, 73 tax. Okay. I need you to copy this. I'm giving you 5 minutes and also calculate the figures yourself. If there is any problem in figures, you should let me know. Okay, 5 minutes for all of you. Okay, so after you are done with investment, revenues, it's selling price less multiplied by units, the cost per unit to units, fixed cost, you get taxable profit, you pay tax. After tax, there is Working capital investment and working capital recovery. So what about working capital? For bookie, we'll need to make a working capital available of 15% of anticipated revenue for the year at the beginning of each year. And working capital will be released at the end of fourth year. So you need to keep working capital 15% of anticipated revenue for the year. So at the beginning of each year. So 15% of the anticipated revenue for the year means in year one, working capital will be 15%, 3250, 488. In year two, 15% of 703. In year three, 15% of revenue, 6758. 1014. And in year four, 1096. Okay, you need to keep this working capital at the beginning of each year. So at the beginning of each year means you need at the beginning of year one, 488. So at the beginning of year one means you should keep it at year zero. Similarly, at the beginning of year two, you need 703. So you will install it at year one, 703. You need 703, but since 488 is already kept, 215. Then at the beginning of year three, you need 2548. So beginning of year three means you will keep it in year two, 254. Sorry. At the beginning of year three, you need 1014. So 1014 means you will install at the beginning of year three. So at the end of year two, 1014. 1014 needs to be kept, but you have already installed 215 and 488. So only left with 311. And at the beginning of year four, you need 1096. So at the beginning of year four means in year three, you need to keep 1096. So you've already kept 311, 215, 488, 82. That's it. Now total all working capital, whatever is installed, 488, 215, 311, 82, you need to release it in the end. Okay. Okay, after working capital recovery, we have scrap value. So remember, we sold all the assets, including plant and machinery, for 16 million last year. And after scrap, there is tax savings, capital allowances. Just copy paste 162.5 as your savings, the last column. Once you're done with it, everything is done. You need to net them all to get net cash flows. 14488. $465. 809. 1648. 809. Okay, these are the net cash flows. So once you get net cash flows, you need to multiply it with discount factor, but in APV discount factor is KE, you get present value. And the net of all present values will be NPV or base case NPV. Now, is KE given? The answer is no. So you need to find K. Is it a normal case or case of diversification? It's a case of diversification. So you need to find K via ungearing, regearing, but you will only do ungearing, no regearing will be done. Okay. So in ungearing, you use proxy data. Proxy Hazem company is given. Okay. And from proxies data, from proxies beta equity, you find beta asset, that's ungearing, no regearing needs to be done. Okay. But here you can see clearly in the question, there are no betas given. So if no betas are given, we use MM plus tax model. Write the equation of MM plus tax model. KE regeared is equals to KE ungeared plus 1 minus T. KE ungeared minus KD T over E. Use proxy data to do ungearing. Okay. And in ungearing, we find KE ungeared. Tax rate is 25%. You need to find KE ungeared. Okay, so proxies K. What is the proxies K? Hazem companies K. See in the last paragraph, 14%. Hazem's last paragraph, KD. So KD is not given. I told you can use RF if KD is not given. RF is 4.5%. D over D is the market value of debt. So balance sheet value of debt is 40 million trading at 94.88 by 100. So 40 million trading at 94.88 by 100 into 94.88 by 100, it's 37.95 million. And the market value of equity, you can see 15 million shares trading at 2.53, 37.95. Same. Both are same. Okay. So this 37.95 over 37.95 becomes 1. I'm doing the working here. So it's 14% K ungeared plus 0.75 K ungeared minus 4.5%. This is cancelled. Okay. So when you will sort it out, K ungearing will be 10%. No regearing is required. Use that 10%. 1.909, 0.826, 0.751, 0.683. You will get present values 14488, 465 into 0.909, 423, 809 into 0.826, 668, 1648 into 0.751, 1237, and 18837.683, 12865. Okay, note them all. It's 709 negative. This is the NPV called base case NPV. Okay, so this is the first thing which I've got, and you have earned major marks. Okay, the other things we will discuss in next classes. Okay, if you have any questions, please ask me. Okay, take care. Thank you.